Crude sets the stage for what the markets are doing. Should that really be the case? And what are the key ingredients that have gone into this move? So that's a lot about what I'm going to be talking about today. This is the 5th of May 2018, and we saw new highs in oil yesterday, and that means a lot because oil has been one of the lead indicators of what we call is inflation or the reflation trade that has been going on in the market. And essentially, it has driven most of the commodity prices or price expectations higher, or rather, you can say inflation expectations that are behind rising interest rates. Now, of course, you can put some of the blame on rates onto the Fed that has been unwinding its balance sheet. But simultaneously, you've had inflation expectations going up because commodity prices started to rise starting from late 2016 or early 2017 once the dollar topped and started to decline. Now that's something that not many were expecting. It's been more than a 1.5 year trend, and the most recent bounce back that we've seen over the last couple of weeks in the dollar has many thinking that that bounce is almost done. Uh, but there are many people who did not anticipate the sell off of the dollar, and they are still anticipating either new highs or at least a reasonably larger bounce back. But my sense is that you've just recently retraced around 61% of the most recent sell off, and that's more or less sufficient if the downward trend has to continue. In the previous dollar bear markets, you actually never got significant, meaningful, larger degree moves beyond this. Most moves just ended at key retracements or at the weekly averages or Bollinger Bands and then continued lower. And that's what you've got so far. So you've reached that level. And if the same pattern is to follow, then my sense is that the dollar starts to decline again. So whatever expectations that had been built up into a sell off in commodity prices, that backs off again. I don't know how the base metals will react. Will they continue to decline? But I'll have to watch them much more closely and be a little less negative. Even if I don't look at the upside potential, I'll have to be careful about the downside potential that was building up for many of them, because even copper had a corrective advance that ended at a key retracement level. So there were reasons to be concerned, but oil has proven those again wrong, because even as it gets close to the 70-72 mark where it would hit equality to the initial wave one based on the channel advance, the setup, the internal wave structure of crude that has rallied since its low at around $58 shows that it has multiple internal extensions, and if all of those extensions play out, then it's unlikely that you will stop even at 75. You might even see 78, or who knows, you'll see 80. And if I take a larger degree structure, if I go to the monthly chart and take that first rally advance when you moved up from 25 $28, and then take equality to that, then you end up with a number which is closer to 88 90. So which of these numbers will be achieved? Will 72 just end up being the initial hurdle, or will you achieve all the bigger numbers? That's the big question. Fifth waves in oil or in commodities in general tend to extend or overshoot, and we are in that stage right now, watching whether an overshoot actually plays out. And the reason holding anybody back, in fact a lot of people have been held back on oil since it crossed $50, and the reason was that twofold. One was data kept coming out that a lot of production was happening, especially in the US, and even though there were oil cuts from OPEC, the higher production levels in the US were leading to a potential oversupply situation. But of course, they've been building inventories as well, so everybody's watching inventory levels. And on the other hand, you've had this huge positioning in the CFTC derivatives data that is published every week, and that data shows that the long positions have reached a record, and with this entire advance above $55, those large positions have just gotten larger and larger and are so big that anybody looking at positions would think that this can't go on. But when you look at 15 to 20 years of CFTC data for any commodity, you'll find that during the bull run periods in even the precious metals or any security that it covered, you've often had huge long positions in the direction of the trend. So purely to discount the trend based on positions is not always correct, especially in a trending market. What does tend to happen is you do get corrections. There is some unwind of positions, and then the trend continues and positions continue to add up. In fact, more often than not, at the fag end of a move, positions actually decrease. So you get a positional divergence, and that's what happens when you have long-term upward or downward trends. But in an up down market, extremes in positions can lead to more immediate reversal. So you can pay attention to these positions when they reach an high for near-term corrections, but they might not necessarily always lead to a reversal, and that is where I keep discounting both the Elliott wave structure and the positions, because it's not necessary that the positions lead to a sell off, and that's what we've seen in oil. We're also reaching a similar stance for both the dollar and the treasury market. So the reason a lot of people got bullish on the dollar once it hit 88 was that there was an extreme short position in not just the dollar index but multiple currencies. So EWI does this once in a while. It adds up all the positions across the dollar pairs and then looks at the total summation, and that too had a huge short positioning. At the same time, you had a very high long positioning on the euro, which continues to be the case. So uh, we've had corrections in the euro as well before, and then when it rallied higher above 1.2, those positions just got bigger. And then again, you had a correction recently, now back to 1.19, which is again a 61% retracement, just the reverse of what the dollar has done. And you're back to levels from where typically you should rally again. And so my sense is that's what is going to happen, even if positions push to higher levels. Now, of course, you break this low, that's when I'll probably change that opinion. But right now, the risk reward is extremely favorable to the euro rallying once more, and then we'll see what it actually does. Now, it's possible that because of the large position, you get a consolidation maybe in the euro before it actually takes off, but and that may then lead to some more cutting back of positions before the takeoff. But the downside, I think, is limited or done, and what you're going to get is either a consolidation or a further move up, higher bottoms, in a sense, and that would now put positive pressure on commodity prices. So apart from oil really taking off to a new high over this week into Friday, surpassing last week's negative close, you're also going to see support coming back to most of the metals. I don't know if I'll still look individually at each base metal for a clear cut buy setup, because most of their setups had weakened last week, and I was more or less looking for slightly deeper cuts, but they've come very close to their 20-month averages in case of zinc or maybe even aluminium. And so there is a case that close to those levels you do end up getting some kind of support. So it'll have to be watched, but I think oil and precious metals offer a better setup where if the dollar starts to fall again, they would likely head higher from here. So all of this would bring back, like I said right at the start, the case for higher inflation expectations, and that directly percolates. And a lot of people just looking at oil to correlate with US bond yields. So even though US bond yields have cooled off a bit on, again, the same thing, super high positioning of shorts in the treasury market, so across multiple yields, when you put together the positions, you have a very high short position in the bond market. But when you look at bond prices and you look at bond yields both on a separate scale, let's just take the 30-year, then it's actually the bond prices have already broken out of what is an inverted, if I take an upside down chart, inverted, otherwise a regular head and shoulders pattern, or a 6, 7-year, 8-year kind of a trend line breakout. And if you take yields, then they've not yet broken outside of that neckline. So the yields themselves have not surpassed the 3.05% mark, but the bond prices have gone past the similar level, because prices tend to move a little more ahead based on the premium discount that futures hold out. So the prices continue to indicate that the trend down for the bond market or yields higher continues to exist, even though you had huge positioning, and therefore every pullback ends up looking like a support point. And so you've pulled back in the treasuries to the 20-day moving average, and my sense is again here, like in the others, that you'd see yields move up. So if you're going to look at a falling dollar, you're going to look at falling bond prices, you're going to look at higher commodity prices indicating further inflation expectations, then if that was the main driver of weakness into the stock markets around the world, then I think these trends will continue to persist. And then the question really becomes about the market's perception about rising interest rates. They take it positively, then probably they can hold some ground. Otherwise, the likeliness is that you'll end up with a similar scenario where bonds and equities both sell off together, like we saw in the months of at least the first few weeks of Feb. After that, those correlations again started to invert a bit. What my sense has been for most of last year, that we would hit a point where the falling dollar would essentially become a reason for bond prices falling, and eventually that would lead to equity prices falling, and you would have all three asset classes declining together in an environment where commodity prices are still holding out. And I think that scenario is still very, very visible and on the mark. And the only reason people have been discounting it is the huge positioning that has ended up in all three: oil, the dollar, and bonds. Definitely not yet in equities, but in all the three indicators, positions have become excessive, putting a lot of people on a back foot, and some of them even to take a contrarian stance that the dollar has bottomed and will rally again. EWI itself has simply called this a fourth wave in the long-term progression and looking for a fifth to all-time high, something I've disagreed for most of last year, and at least rightly so till now. But the question is, will it now turn around? So I think you're at a critical point, and unless you go beyond these highs to 92.50, 92.80, I would still maintain a negative stance for the dollar. If it goes beyond that, then maybe I'll look at a further retracement into the next month or so, and so that would change my opinion. But I think we are at a point where more likely you're going to see some downside to the dollar, at least near term, but most probably even medium term. And if the positions do not play an important role in the trend that develops from here, then you pay more attention to the trend than to the positions, is what I would say, because the momentum would continue to be strong in favor of all of these asset moves, and they would have a very direct bearing on equities, which is why I've spent so much time talking about it in various previous podcasts, and I'm doing so in today's video as well, so that you get an insight into what I think is the most important factor to watch out for. And so when you look at Indian bond yields as well in the same perspective, the moment the government announced that they were going to postpone their borrowing program to next month, bond yields dropped all the way from 7.8% down to 7.2, but they could not stay down there. Within days, they bounced right back. Now, just on Friday, yesterday, the RBI's announced OMOs. Just when I would think probably that yields push up again above 7.8%, they announced around 10,000 crore worth of OMOs. OMOs to me are nothing more than similar to QE, which is you are essentially buying bonds directly from the market. So it's not a large sum. I guess the amount once announced would get discounted within a day, but it probably provides, along with the overnight bounce back in the S&P, some positive momentum for stocks on Monday. But my sense is that that momentum might be temporary, but still it could give you that 50 points or more bounce back in the Nifty on Monday, based on the overnight moves and the announcement that you're going to get some injection of liquidity into the bond market, and so that could cool off the pressure on the rupee as well. But the rupee's main pressure point is probably coming from commodities, and especially from oil. The imports that you would have to actually make. Apart from that, the dollar actually rallied over the last month, so both of those combined put pressure. But at the time the rupee started weakening in Feb, the dollar was still falling, so the main reason was weakness in equity. So these are multiple headwinds for the currency pair, and that it has taken support at the 20-quarter average and the 40-month average. We are essentially moving towards the upper end of its medium-term range, though it has achieved the short-term targets. Unless we see a clear-cut reversal in the higher top, higher bottom structure, you have to be open to the idea that it can continue to stretch on the way up towards the 69 mark. I'm just not sure whether it will get past that in this move itself. You could halt there if you're forming a long-term triangle, or if you've already started the longer-term fifth wave, you can get past that as well. So you have to be open to those options, but I would probably expect, structurally being a long-term fourth wave, that you still halt there and pull back once more to complete a long-term triangle, but it's not necessary. So the near-term outlook then again on the currency would be that you see a weaker rupee, and so that would along with bond yields end up putting pressure on equities as well. So there are multiple headwinds that I think are likely to be a pressure point for equities in the coming month. And so getting past these levels might not be easy. So you've actually pulled back to varying retracement levels, 50% or more on the mid cap indices, a little over close to 66% on the Nifty, and close to 70% on the broader Nifty 500. But all of them appearing to have lost momentum there, and on thin volume, this entire advance we saw breadth actually start to weaken. For in fact, the entire of last week we've seen negative breadth, and volumes also thinned out into the rally, and so both of those are signs that this is a counter trend bounce. So none of the signatures of a larger move were there, and as I've discussed in my previous video that there was a short squeeze in the month of April which more or less should have completed, and if you just look at the FIA positions, they started at 0 to positive now, in fact, for the last couple of weeks. So their shorts were completely cleared out through post last expiration. And what we need to watch now is what really happens on positions and trends in for this month. So we've seen some unwind on the put side, though the month started with a rollover of a lot of puts. We've seen an unwind happen on Friday, that is on the sell-off that we saw yesterday. There was significant amount of call writing. We'll see whether those trends persist in the coming days, and that would give further indication to the downside risk. But my sense remains that the best of the upside is done, and a lot of people are beginning to talk still of one more new move to an high and then a top. Well, if everybody can see that happen, it's like the expectation that you're going to get this final melt up, and this talk is not just in India. You can hear it even for US markets. A lot of people expecting a final melt up, but for anyone who's an elitician or looking at elite waves, it should be on classical methods hard to ignore the 5-wave decline that we got from the high, at least for US indices, S&P and the Dow, from the peak that we made in Jan. So that first sell-off was essentially impulsive, and unless that is really ruled out, everything else in between is part of a corrective structure. It could be a triangle, and what you'd continue to expect is further downside based on that one single reading. Now, I did try to consider whether this entire pattern is triangle, but like I said, the impulsive nature of that initial sell-off means this should not be a triangle, and if it is, or it was, it would really require the support of the two key factors, like I said, bond markets and the dollar, to actually work themselves in the opposite direction than they have for most of this time period. And if you don't see a cooling off of inflationary expectations or rising bond yields, then it's unlikely that this is a triangle and you're getting one more heads up. Most likely the case is it's the other way around, because you have some people are missing this, that you're already into quantitative tightening mode, which means $30 billion of bonds are being left into the market, apart from the new borrowing that all the new programs announced, the tax cuts and so on, would lead to in the US bond market. So the upward pressure on bond yields is most likely to continue as far as US yields are concerned, and that continues to put pressure even on the Indian bond market so far. And because we have our own borrowing program, most of it pushed into the second half, the market is always anticipatory in nature, and which is why you saw bond yields bounce right back. So unless the RBI just keeps intervening and trying to push these yields down, the likeliness is that we are going to see higher interest rates in India as well. The wave structure of the bond prices also indicate the same, that we've started an impulsive advance that is likely to carry bond yields in India to much higher levels, probably to well over 9% eventually. Might not get there right away, but eventually that's where we are headed. And so that bond yield shock is something that we'll have to deal with in the months ahead as we move on. So no signs there. Anybody thinking that the market's still in a phase where it is running away to the upside, then that's definitely not showing up in the structures that we are watching so far. So you just have to come to terms with that. the best case scenario is done. The question is really about how we will unfold on the downside from here. I think that's what you need to really think about, not about how you'll go back to 11,500 or 12,000. If the momentum or strength shows up, we'll deal with it, but I think you need to be prepared more for what is the downside. And just think about it this way: there are a lot of key stocks that should have actually driven the Nifty to those levels. So anybody who was anticipating a higher move, and I was open to it at least last month, because I too could see a new high in IT stocks. I could see Reliance making one more attempt because of its triangular structure to a new high, and I wrote about those things. All of that happened, and still you have a Nifty which is not gone beyond the 61% retracement mark. So having made those moves, now to continue to anticipate a new high when stocks like Maruti are giving up, even though Kotak has made a new high, Hindustan Lever made a new 52-week high and gave up, and still you don't have a new record. So you really need something else, and if that something else, whatever it is not yet evident, then I think it's time to pay attention to market risks all over again. So that's my roundup of all that has happened. The Fed has this week continued to indicate that it continues on its program. The only relief that the market got in the last 2 days was on announcements that they were okay with higher inflation, and if that's a reason for the markets to feel happy, it also means that they are likely to continue on the path of higher rates. Whether slowly or fast is hardly something that we can ponder over, because they've already given a timeline in terms of both the unwind and the rate increases. So since the timeline is known, I don't know how these comments really matter unless the trajectory of inflation itself changes, which has not yet happened. So what you are essentially looking at is the potential for a stagflationary kind of environment where you have slow or flattening growth, okay, or even slower growth. I have read research reports which say that the US will see slower earnings growth in the coming quarters. So you're already looking at slowing growth, although growth numbers are still showing up. And on the other hand, you have inflation which will continue to accelerate at least for another quarter, after which it may cool off, but we don't know that yet. At least we know that the immediate moves are to the upside as far as inflationary expectations are concerned. So these are the headwinds we'll deal with over the next month or two. It will be interesting to see how the RBI reacts to all of this into the first week of June, when it comes up with its own policy meet. By then a lot would have happened, especially things like rising oil prices, and they're probably going to try and contain the higher bond yields, or else what I would think is RBI would have to actually catch up with the bond market and raise rates to keep those expectations under check, or to counter what has become a consistently weakening currency. So that's all in this update. Thank you.